Thanks for clicking. Canada's fixed mortgage rates are on their way up and likely won't be reversing for quite some time. This according to a recent post on the Toronto Star. Yeah, and they're not wrong. As we'll see today, fixed mortgage rates continue to go higher as the yields on the 5-year Canadian government bond also continue to surge. But the article from the Star also makes the point that variable rate mortgages won't be changing very soon either, noting that if you do choose variable, you are betting against history.
Did you gamble? Huh?
And although, as we'll see, I don't agree with how the article gets there, its conclusion that we should be cautious on widespread variable rate adoption is one that was supported by a recent speech given by the Deputy Governor of the Bank of Canada, Sharon Kozicki, who noted that while the central bank continues to be worried about inflation, the economy isn't looking as bad as the bank had initially thought.
If you say so.
Fair point, and we'll get to that. Given that variable rate usage is currently spiking, I think it's worth going over the arguments put forward by the Toronto Star, especially since they appear to be backed up by our Deputy Governor of our central bank. So what I want to do today is go over my best mortgage rates for the month of June, take a look at the Star's argument that rates won't be going any lower anytime soon, go over Governor Kozicki's speech, and then discuss some implications. As we'll see today, what happens in the United States very much dictates what happens up here in Canada. And to help us understand that a bit further, I am going to be interviewing Christopher Whalen, author of Inflated, Money, Debt, and American Dream, who will give us a bit better insight as to what we can expect coming from the United States. Make sure you click like and subscribe if you want to get that update, but for now, let's get into these mortgage rates. Out of the mortgage rates, first up, my best 5-year fixed insured mortgage rate. An insured mortgage, if you remember, that's where you have that less than 20% down. You have a 25-year amortization or 30 for first-time homebuyers. You qualify at the contract rate plus 2% or 5.25, whichever is greatest. And of course, you pay that mortgage insurance. My best 5-year fixed insured rate back in April was 3.99. That's now bumped up to 4.09 in June, with variable sitting at prime minus 1.06 or 3.89%. So yeah, with fixed mortgage rates heading up and variable rates moving downward, there is now a financial incentive for buyers to take on that variable rate mortgage,
where nothing can possibly go wrong.
Next, my best 5-year fixed insurable mortgage rate. An insurable mortgage, if you'll remember, that's where you have that 20% down. You have an amortization of 25 years or less. You qualify at the contract rate plus 2% or 5.25, whichever is highest, and you do not pay that mortgage insurance. My best 5-year fixed insurable rate in April was 4.09, and again, that's up 0.1% to 4.19 in June, with variable sitting at prime minus 0.86 or 4.09%. And then finally, my best 5-year fixed uninsurable mortgage rate. An uninsurable mortgage, that's where you have that 20% down. You have a 30-year amortization and or you take money out of your home vis-a-vis a refinance or an equity takeout. You qualify at the contract plus 2% or 5.25, whichever is greatest. And of course, you don't pay that mortgage insurance. My best 5-year fixed uninsurable rate back in May was 4.25 and is now sitting at 4.29. with variable sitting at prime minus 0.55 or 4.4%. So most of the rates up by 0.1%, 10 basis points since the last update at the end of April, which makes sense as the yields on the 5-year Canadian government bond are also up about 15 basis points since that time as well. And according to the Star, although shoppers might be waiting for mortgage rates to hit that mid-3, mid-2% levels, they could be waiting for a very long time, as, according to the Star's account of its interview with a mortgage broker, historically, the fixed and variable rate mortgages are in line with historical norms.
But historically, historical changes have come out of war.
But what I think the article means is that historically interest rates have not been sub 4%, which is 100% the case. According to a study from the Bank of England, the real rate of interest, interest adjusted for inflation, is about 4.78% over the past 700 years, with another study tracking the last 3,000 years worth of interest rate data, showing that sub 4% are truly a very minor aberration, seen only in the 1930s and the past 15 years.
Here's the New World Order, guys.
And we can see this on the yield on the 5-year Government of Canada bond as well, which was only allowed to fall sub 2.5%, enabling those 2 and 3% mortgage rates in the aftermath of the global financial crisis and during COVID. What we're seeing right now is far, far closer to what we would call normal. And I do mean that that yield was allowed to fall, as the yield on the Canadian government bond tends to fall in lockstep with the yield on the 10-year US Treasury, which was also abnormally low during those periods. And as to why yields are currently running so high, we've covered it at great length on this channel, so I don't want to get too far into the weeds right now, but suffice to say, for now, that it's largely due to the sustainability, or not, of the US fiscal position. Just as banks ask for a risk premium to lend to riskier borrowers, what we're seeing right now is that investors are asking for a risk premium to lend to the United States. So, fixed mortgage rates artificially low for the past 15 years. Those fixed rates, which are determined by the yields on the Government of Canada bonds, which are in large part determined by the yields on the 10-year Treasury, which are up massively on the unsustainability and inflationary nature of US deficits. So those fixed mortgage rates probably aren't going back anytime soon. But what about variable rates? Aren't those heading down during these times of economic uncertainty?
Yes, now it will last forever.
But what about variable? The argument put forward in the Star is that once the Bank of Canada has cut 6 or 7 times, the rate doesn't usually go down further. The Star notes that rates typically go up again after this many cuts, so if you choose a variable rate mortgage, you are betting against history. So the Star is presenting the argument that since we've already had 7 interest rate cuts coming from the Bank of Canada, totaling 225 basis points, that history says we shouldn't expect any more. And while I think the argument used to support this argument that since the Bank of Canada has already cut 6 or 7 times, that we shouldn't expect any more cuts is methodologically flawed to say the least. It's overly simplistic. It relies heavily on averages without considering the extent to which massive outliers skew those averages. The conclusion drawn that we should still be wary about variable rate mortgages, I think, is worthy of consideration, since Bank of Canada Governor Sharon Kozicki on Friday said that patience is needed before we see any rate relief, that the economy isn't looking as bad as the bank had once thought. Yeah, in watching that speech, Kozicki painted a very stagflationary picture, and it's pretty clear that the bank isn't overly certain as to how this will all play out.
So we have the economy weakening and we have price pressures going up. This is a huge challenge. We have one tool, a policy interest rate. It's hard to stimulate to bring back demand at the same time as you're straining to pull down prices. Right? You can't do that.
Yeah, as we've been speaking about on this channel, the bank right now is very much in between a rock and a hard place. And for now at least, it looks as though they're not overly concerned about the economic portion of the equation.
Overall, firms believe that their worst-case tariff scenarios were much less likely to materialize than they reported earlier this year. While uncertainty remains high, there was less talk of catastrophic outcomes. But firms have now started seeing concrete impacts on their performance, and they're finding it challenging to formulate their outlooks. Most businesses expect activity to weaken in the near term, which puts jobs at risk. In addition, firms spoke about their costs increasing, which likely means they'll need to raise prices at some point. Governing Council considered this information with other data and analysis in deciding yesterday to keep our policy interest rate at 2.75%.
So that all tells me that the bank wants to portray the stance that it's marginally less worried about the economy than it is about inflation. For now at least. And I say portray the stance, as we've discussed before at great length on this channel, that governments, since always, have lied.
Why?
To affect and direct behavior, it's less likely to trigger popular unrest than is, say, other more coercive measures.
That's not very nice. I know.
This is a bank projecting the stance that they don't want people borrowing money to stimulate the economy. This is a bank that's worried right now about price increases. And I believe this far more than I believe the low to 2023 nonsense while the bank was printing up a whole lot of money, as there's really nothing in it for them to lie. Unlike low to 2023, where the rates couldn't get any lower, so they had to push a bunch of nonsense to get people to continue to spend to support the economy, that's not really the case this time. If they wanted people to spend, they could lower interest rates. If they wanted people to not spend, they could raise interest rates. I just don't see the motivation for them to lie about future price increases if they didn't see it coming down the pike, and I also think we are all seeing it already at the grocery store. Now, that doesn't mean at all that the Bank of Canada won't be cutting. In fact, I wouldn't be surprised if they did. I wouldn't be surprised if they went, say, 50 at a time, at some point over the next few months and years ahead, thinking maybe that a half-point cut will do far more to trigger market reactions than a single or double 25 basis points here or there. But it's not on the bank's immediate radar. So I don't really think it's so much that the bank has already cut 6 times, so now they can't or won't going forward, as it just boggles the mind that the experts that the media chooses are ones that clearly have never taken a stats class.
What's that?
It's more that the bank is worried about prices due to the Trump tariffs. So what I would say is that if you are going to take a variable rate mortgage, especially on the insured side, it is likely that you are going to be rewarded moving forward. With that said, as we've talked about so many times before on this channel, taking a variable rate, especially right now in 2021, isn't one of those set it and forget it type of rates. You have to keep an eye on the bond market and you have to keep an eye on inflation. I say keep an eye on the bond market as you can always lock in your variable rate, but should you decide to, the fixed rate at which you can lock in will be dictated by the ones available in the bond market. Or based on what's going on in the bond market, you can't borrow for the same rate as can the government of Canada. And of course, keep an eye on inflation, as if prices continue to creep up, that's just going to be longer and longer until the Bank of Canada can cut more, or, and never say never, increase interest rates to combat that inflation. So, fixed mortgage rates moving up on pressures coming out of the United States, variable rate mortgages likely to remain sticky for some time, again on pressures coming out of the United States. We have a very uncertain central bank, well aware that it's between a rock and a hard place, but judging from the speech, it looks like it sees more risks right now at least, stemming from price increases than it does from economic collapse. We will obviously continue to track Canada's mortgage rates on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.